Well, come on in. We're going to talk to you a little bit about who Bequest is and our investment strategy that we've been deploying over the last 5 years. We're calling this presentation Stress-Free Investing in Volatile Times. And so I'm just going to take you through a few slides where I really want to kind of make a point of the way current structures are, current portfolios are set up, and how we look at it differently. And then talk to you a little bit about some private markets. And we actually have an agenda here. I should probably just go right to it. But we're going to talk about the changes in the public markets, how we believe the 60-40 model that we were all taught in the day is broken, the shrinking opportunities in the public markets, specifically what's going on with the Mag 5, the structural shift towards private markets, and then we'll get into who Bequest is, what we do, how we've been serving investors over the last 5.5 years, going on 6 years. And if you have questions, feel free to kind of, let's make this interactive. The last thing I want is this to be just another boring presentation. You guys have showed up here, and I just want to make sure that we get the best use of our time. We only have about 45 minutes here, and so I want it to be beneficial for you. And so if you have a question at any time, feel free to engage me. I am easy to work with here. So if you've noticed recently that the 60-40 model, we believe is broken. We believe this strategy has been broken for some time now. And if you look at what's going on, the projected returns in the stock market over the next 10 years, it's actually around 5.4% is the implied return here. And that's because what's going on in the bond market and the stock market is they're moving in tandem. When the markets go up, the bond market goes up. The markets go down, the bond market goes down. This implied diversification that we would get in our portfolios between a mix of bonds and a mix of equities is not achieving the objective that it once did. What's also interesting is if you look at real income that's generated compared to what's going on with inflation, you can see this slide here will show you that we're not actually earning what we think we're earning in the equity market, in our portfolios. In fact, what's actually going on is we're barely generating enough return to beat inflation. Another interesting issue that we're dealing with in the public markets is that now the Mag 7 represents about 34% of the S&P 500. 7 stocks. The performance of 7 stocks represents 35% of the S&P 500. So when things are great, the S&P is great. But as we noticed this week, last week, when a few stocks decide to dive, it actually brings the entire market down. The argument that we're making here is that public markets are shrinking. Public markets are shrinking. I actually have some stats here about the size of public markets versus private markets. Do you know that in the last 5 years, private markets have doubled in size? Doubled in size. The public markets are still very large, but there's this shift of opportunity that's moving into these private markets. Another interesting stat here is that I don't know if you know this, but 87% of U.S. companies are private. 87% of U.S. companies are private. that means the public markets, these 3,000 companies that we're all investing in, only represents about 13% of the market. And so why is it that not only the number of private companies continue to grow, and why is it that capital is moving away from the public markets to private? Why is it that's just a handful of companies that are even representing the S&P 500 today? It's because I think people have lost faith in the public markets. A lot of institutions are moving capital out of the public markets into the private markets. And there's a massive amount of opportunity here. And that's the point I want to make. We see that private opportunities are growing. In fact, in our space, the alternative investment space, we're seeing massive growth. Massive growth. People are leaving the public markets and looking for private opportunities. And you see this in the headlines today, right? The current administration is trying to enable more alternative investments into everyday Americans' hands. There's a bill on the floor where they're trying to get access to the 401k capital. I don't know if you've seen that. The private markets are trying to get. So there's this big movement, and so the big question everybody asks us is, well, where do I find access to private opportunities? It's actually very difficult. We are trying to promote who Bequest is, and we've been now around for almost 6 years, raising capital in this market, and it's not easy to get attention. It's not easy to get attention in our space because we don't have the deep pockets that Wall Street has, and so it's not easy. A lot of people really don't know who we are. But in fact, we've been generating passive income for our investors now for almost 6 years. And so our mission here at Bequest, if you're looking for passive income, if you're looking for consistent, predictable returns, our mission here is to help you achieve financial freedom through consistent, high-yielding income strategies backed by real estate and energy. And we'll talk to you a little bit about what our investment strategy is here in a moment. But some of the milestones that we've accomplished this year, it started out about 6 years ago with my business partner and I. I met him because he wrote a book. In 2017, my business partner, Martin Sines, who's a solo entrepreneur, writes a book about how to buy mortgages off the secondary market. I won't forget where I was. I was in Denver at the time, working in corporate America, slinging technology to Fortune 100 companies. I was looking for something new. I had always been an investor my whole life, and I was a Section 8 landlord. And I found this book that had just been published in May of 2017, and it taught me how to buy mortgages from the banks. I'm like, is that even possible? Do banks even sell mortgages? I thought at the time the only way to buy a mortgage was to get into a bond, mortgage-backed securities. That's the only way I could generate a return from this asset class. And I'd known this asset class well because I owned real estate. And during my years of investing, I realized that I would buy a property and I would finance that property. And sometimes I would not get paid rent. But I guaranteed that the bank got paid every month. Month after month after month. It didn't matter whether I got paid my rent. And so I always thought in my mind, I'm like, wow, the bank's got a great position. They get paid no matter what happens. If you own real estate, you know Murphy seems to show up a lot. And so whether Murphy showed up or not, the bank got paid. What I also thought was interesting is the bank never lent me the value of the property. It was always at some type of discount, as if, if I defaulted, they would actually get more than they were owed. I'm like, wow, that would be an amazing position to be in. So here I am in 2017, working in corporate America, and I find this book that teaches me how to buy mortgages off the secondary market. I'd never emailed an author in my life, and I sent an email to an author of a book because at the very last page of the book was his email address. What's so interesting to me is within 5 minutes, the author emails me back. And I told him, I said, this is exactly what I'm looking for. I own real estate. I want to scale my business. I want to learn how to be the bank. And he taught it to me. And I flew across the country to Stafford, Virginia, to meet the author of this book. And I asked him if he would teach me the business. And he did. And after 6 months of him teaching me this business, we went into business together. And my business partner is Martin Science, who wrote that book. We started Bequest together. And here we are, 6 years later. We actually started another company first, and then we launched Bequest on March 13, 2020. And here we are, almost 6 years later. We have accomplished a lot as a team. As I mentioned, 5.5 years, 300 investors call Bequest home. We have consistently delivered returns to our investors for the last 5.5 years. In 2025, we thought it was really important for us to become a registered investment advisor. We don't advise people anything, but we do sell investment products. And so we thought it would be great for us to get registered with the SEC in the state of Florida. That's where we reside as an investment advisor. 2025 has been one of the best years in the history of the company. We've raised a lot of capital this year. We've put that capital to work in our investment strategy that's been working for the last 6 years. And so we've raised over $13 million this year. We will close out this year raising about $16 million. And we will go on to raise $30 million next year. In a very growing, rapidly growing market where people are hungry for private investment opportunities. And that's what we provide here at Bequest. We have 3 funds that we operate here. And I want to talk to you a little bit about the different investment strategies. But in our first fund, we have about $22 million currently in that fund. That fund today has been providing cash flow for investors for the full 5.5 years. We buy what's called reperforming mortgages. My business partner, Martin, in his book, taught me how to buy mortgages from the banks. You see, we buy a very specific type of mortgage, performing mortgages. But these are mortgages where at some point in the history of the life of that mortgage, the borrower fell on hard times. It's typically for 3 same reasons. It's either loss of job, it's a divorce, or it's a health-related situation. It's always the 3 same reasons. And I'm sure all of us have gone through some hard times in our life. All of us have gone through something like that. The good news is that when that situation happens, most of the time, it's a temporary situation. People get remarried, they find another job, they get healthy again, and they get back on their feet. Well, when that happens, and a bank owns this loan in a securitization, that loan falls out of securitization. Most likely gets kicked out of that bond securitization. And eventually, the banks are stuck with a bunch of mortgages where the terms have been modified. The terms have been modified. I mentioned the borrower's back on their feet again. But those terms have been modified from the original term to help the borrower get back on track. And the bank, because of regulations, are required to over-collateralize those types of loans on their books because they fell out of the securitization. And those are the loans that we buy. We buy them all across America. And when we buy them, the borrower is paying again. But at some point in time, Doesn't matter when. It could have been a month after origination. It could have been 2 years after origination. There was a blemish on the pay history. And so those are the types of mortgages that we buy. And when we buy these types of mortgages, we demand a discount. And so we'll buy these loans at a discount from the banks. We'll put them into our fund, like the Bequest Income Fund, and we will sit there and collect those payments to maturity. And that's how we generate returns. That's one of our oldest funds, and that's what Martin taught me how to do that in 2017. Recently, we launched a Bequest Legacy Fund here. This is our multi-strat fund that we've been operating now for almost 3 years. It has about $11 million in capital. It's a multi-strat fund. Again, these are all, everything that we do generates cash flow. If it doesn't generate cash flow, it's not in the fund. And so the Legacy Fund has our reperforming mortgages in it. The Legacy Fund also has commercial real estate. I haven't talked about commercial real estate, but we have a passion for commercial real estate. Over the last few years, commercial real estate has taken a beating. We specialize in buying medical office buildings because we know that during times of recession, you'll still go to the doctor, you'll still go get blood work done. There's a demand, doesn't matter what's going on in the economy, and so we're big into medical office. We're also big into commercial real estate in specific markets where there is none, like Sarasota, Florida, the home of the Moneyshow and the home of Bequest. In our town, Sarasota, I don't know if you've been there, but there's a lot of residential properties there. There's very little office space. And so it's a growing town. People seem to be coming from the Northeast down to Florida, and there's a demand. And so we buy commercial real estate in pockets of opportunity where we see value. We also have what's called modern energy in this portfolio, and I'll talk to you briefly about that in a moment. But what is interesting, we've been operating our products now, I mentioned, for over 5 years. But in 2024, we had a lot of demand from investors who said, listen, Sean, I've been with you guys a lot, but I have friends who are not accredited. I don't know if you know those terms, right? Accredited versus non. They're non-accredited, and so they can't buy your product. I said, yes, you're right. They cannot buy our product here at Bequest because the federal government allows us to operate our funds if and only if we sell them to accredited investors. And so for the first time, we went to the SEC and we asked for permission to take our investment strategy to the general public. And all through 2024, we went through a process of getting what's called a Regulation A fund approved. And after 9 months and a lot of attorneys, the SEC approved our product to be sold to everybody, not just accredited investors. And so we launched that product this year. That's our Bequest bond here down in the corner. We have performing mortgages that back that product. And so for the first time ever in 2025, it didn't matter who came to Bequest, be accredited or non-accredited, we have a product for you. We have a way to generate cash flow through mortgages. We have a way to generate cash flow for you from commercial real estate, from modern energy. And so if you're looking for consistent, predictable returns from real hard assets, that is what we do here. Here's a current list of the offerings, and our investor relations team will be happy to take you through the details of each of these products and how they work. But on the Legacy Fund, the far left, that is our highest yielding return. If you come into that multi-strat fund, there's different minimums, there's different time commitments. Everybody asks us, is the investment liquid? You get to pick the liquidity of your investment by picking the class that you want to be in. If you want to pick our highest class, we offer a 12% return class. That is a $500,000 minimum investment, and it's a 3-year commitment. You may say, well, I'm not interested in locking my money up for that long. Well, we have other options for you inside the legacy fund. If you are interested just in our reperforming mortgage fund, that's the fund in the middle, it generates anywhere from an 8 to a 10% return, depending upon the level of commitment you make from a time and from a capital perspective. And then if you have friends and family who are non-accredited, we have an option for them in our bond fund. We even say, listen, we understand that investing in an illiquid investment might be the first time you do something like that. And so we tell people to go into the bond, test us out, see if what we say actually happens. And you can come into the investment just $1,000 into our bond. I mentioned a little bit about our performing mortgage portfolio. And that's like the foundation of everything that we do. 80% of the cash flow that's generated for our investors comes from owning mortgages. And you might say, well, that's great, but I remember in 2008 what happened. And I don't know if you've seen a movie called The Big Short. And so yeah, I've heard that before. So Sean, how are you guys going to protect from The Big Short if that happens again? Well, the first thing I would say is we're bullish on the U.S. housing market. We still believe to this day that there's a massive undersupply of units. But beyond that, what I would tell you is we are very focused on one thing. When we buy a portfolio of mortgages or we buy individual mortgages, we're focused on what is the collateral worth. At the end of the day, when it really gets bad and there's not a borrower there to pay the loan, what do we have? We have a property. We have a house. We have a single-family residence that is our collateral in the event of a default. And so we have to make sure that that asset is worth significantly more than what we're owed. And so that's what we do. Here at Bequest, when we evaluate pools of portfolios of mortgages, we make sure that we have at least a 35% equity cushion above our position. We call that our investment to value ratio. And so if I mentioned we're in mortgages at a discount, we buy them at a discount. So let's say it's $1 million property, right? In order for us to have a 35% equity cushion, it doesn't matter what the balance of that loan is. We would buy that loan at $650,000. So we're in it at $650,000. That's $1 million property. If, in fact, the borrower defaults, we get to take the property, right? And so that's how we protect our investors against what happened in 2008. In fact, I tell everybody, if, in fact, the banks had lent at a 65% loan-to-value ratio back then, those banks that disappeared would still be here, a lot of them. And so that's one of the strategies we do here. Another thing that we do here that drives performance in our mortgage portfolio is we only buy mortgages where it's occupied by the owner. And so we only want a property with a borrower who lives there. Why? Well, because beyond the numbers that I shared, beyond the investment to value ratio of 65%, there's another phenomenon out there that we rely on called emotional equity. And that emotional equity has unlimited value in our minds. Because little Johnny grew up there in that house. There's notches on the doorpost. They're going to want to keep the property. because of the emotional tie to it. That house could have been passed down from one family member to another, and there's an emotional tie to that property. And so when things go bad, economies go bad, borrowers stop paying, these are the things that we rely upon to make sure that we can protect the capital from our investors and continue to generate a return. And so when things go bad, we know that we have these things in place to generate these types of returns. On top of that, today, we have a team of people that work inside of Bequest. And so when loans go bad, because 1 out of 10 of these loans that we bought from the bank will go bad again. When those loans go bad, we have a team of people that work here at Bequest that rehab the loan. Some people rehab houses. Here at Bequest, we rehab the paper. And so what does that mean? That means we get on the phone with the borrower. We discuss the situation. We work out a payment plan that works for all of us. We get them back on their track, and we get them paying again. That's what we do to generate returns here at Bequest. And this is how we create a win-win situation, not just for our investors, but for our borrowers, even the communities. If you've ever been in a neighborhood that has foreclosed properties, you know that not only does that property being foreclosed impact whoever's living in it, but it impacts all the people around it. And so it can impact the entire neighborhood because nobody's mowing the grass from that house across the street. Everybody knows it's in foreclosure. And so we do a really good job generating returns off of these types of mortgages for our investors. I mentioned a little bit about our commercial real estate investment strategy. And these are two examples of properties that we have. On the left there is a medical office building in Houston, Texas that we manage. When we bought the property, it was about 65% occupied. And so what do? Well, our team comes in, and there's a massive focus on operational excellence, right? Making sure we've got the right property management team in there, making sure we've got the right leasing team incentivized the correct way to lease up the property. And it's not been an easy environment for us to generate cash flow in commercial real estate over the past 5 years, but we've actually been doing it. Our property there in Houston, Texas is almost 85% occupied, when most in the area are about 70% occupied. This is our Bay Plaza in Sarasota, Florida, where I mentioned there's a lack of commercial real estate space. We actually bought that property last October. It was about 10% occupied, and within a year we were able to get it up to 100% occupancy. This is how we generate returns for our investors. We generate cash flow through mortgages. We pair it with commercial real estate. And then we pair it with something interesting, with modern energy. You might say, well, I've heard of energy before and never modern energy. So is this just a term that Bequest created? Well, I didn't tell you a little bit about my background, but before I read that book and flew across the country to meet Martin, I was helping develop investment technology strategy for Fortune 100 companies. I used to build data centers for Amazon, Google, Facebook. Like, that was my career. I would go in and help them build these data centers. And never before did we ever think about the cost of electricity when we were building these data centers. But that's changed drastically. And so 2 years ago, we found an opportunity down in South Texas where we built what we call an energy park. And so down in South Texas, we locked up about 7.5 megawatts worth of capacity on the ERCOT South grid. We locked it up with a contract, and we began to build out the infrastructure. to distribute the power to tenants on that 3-acre plot of land that are computers. And so we built this energy park for both AI and blockchain workloads. And our tenants and that property are little computers. They come in and they consume a massive amount of electricity. And we buy the power at about 4.5 cents per kilowatt hour, and we sell it to them for about 8. And so we're making a power arbitrage on the return on the power just because we had locked it up under contract and we have been selling it to our tenants. We didn't realize what is actually occurring today would actually happen. I didn't think it would happen this fast, but if you turn on CNBC today, you would find that there is a massive demand for electricity because of AI and blockchain. We were ahead of the curve here, and we own an energy park down in South Texas, and that's how we actually generate returns in the legacy fund. So just to recap, I don't know how much more time I have. 5 minutes. All right. So this is our investment strategy here. It's 3 pillars. Again, residential mortgages, commercial real estate, energy. That's how we generate cash flow for our investors. You come in for a certain period of time. You're a limited partner in that entity. That entity generates cash flow for you and distributes that to your bank account every month. And we've been doing that now for 67 consecutive months. The 4 things that we focus on here, cash flow. Everything's about cash flow. We control the assets. We control the assets. When you put capital with Bequest, we go out and acquire the assets, the hard assets, and we manage it with our team. Our team is doing the work. We're not farming it out to somebody else, some advisor. We're literally putting the assets to work and we're managing ourselves. And so that's part of our 4C philosophy. Cash flow, control, everything that we do is comprehensible. This is not complicated. If you own a piece of property, you know what we do. If you have a mortgage, you know what we do. And then the last thing is community. And everything that we do impacts the community that we serve, both on our investor side and on the asset side. Just have a brief video here of one of our investors.
With Bequest now for 46 months, just shy of 4 years, and I'm in 4 separate funds currently. I started out in the Reperforming Mortgages Income Fund, then got involved in the Equity Fund with Fallbrook, and then I invested in the CMJV2 Fund with the Bitcoin mining, and I recently also expanded into the Legacy Fund. I met Martin at the Money Show, and he was giving presentations, and I'm a very conservative person. I think I watched presentations 3 or 4 different Money Shows, and then I finally touched base, and I got to know Martin very well. It's been flawless. It's been 46 straight months in the income fund, and the money hits my bank account same day just about every single month. I get statements on a regular basis and keeps me informed. The passive income comes in very timely, and you can really count on it. I wanted something to complement my investment into the stock market, and with the stock market going up and down so much, I decided, well, I wanted to look into the passive income route and everything, and to be honest with you, I've been very impressed. So my level of confidence had to be very high for me to have invested in 4 separate funds at Bequest. I sleep a lot better knowing that my money's at Bequest. And Sean and Martin, as well as Jim Hershag, they're always available to talk to you if you have questions. It's a family environment, and I've been investing for decades and decades now, and I've never had an experience like this where if I had a question, I would send somebody an email, and the 2 co-owners of the company would get back to me within 24 hours. And it was just phenomenal, and my level of confidence in investing and feeling comfortable that not only will my money be there, but the passive income will consistently and periodically be there as well. One thing about Bequest is they always emphasize the simple fact of compounding. And if you don't realize, the stock market on average will return about 9.5% per year, and then you've got to worry about all the ups and downs. If you get into the Bequest passive income, you're making about the same, if not more, than it is on average. And some of the higher funds in Bequest are actually earning more than what the stock market's earning on average. So it's a great addition to my investing in the stock market. I think it's family. They do treat you very well. They are concerned about you in the sense that they offer free training to their investors all the time. I think I've attended every single one of y'all's training classes over the last 4 years, and I've learned a lot. It was a side passive income. I wasn't familiar with it before investing in Bequest, and it's really added to my portfolio, and I think that everybody really should have Bequest in their portfolio, or at least consider it.
Well, thank you, Mac. We've been working now with the Money Show for 5 years, pretty much from the beginning. And so a lot of our investors have come from the Money Show. Our team would love to sit down with you and talk to you more about our investment strategy and how it works. We have some great tools that we give away for free. We have our kits that we provide that help you make better decisions on investing, help you generate a cash flow plan for your life. And so our team would be happy to give those to you. You can stop by the booth to see our team and or scan this QR code to book a meeting. But I'm just going to leave it open for questions. I don't know how much more time that we have. But if you have questions about Bequest or our investment strategy or how it works, I'm kind of here to kind of answer those questions. Yes?